Hello guys, my name is Febriyan Mustar. The meaning I've been taking this video is to answer some questions. And let's to the first question. The first question, how much of the growth in revenue is due to greater volume and how much to higher price? The answer, business has grown. Total asset increase includes store fixed asset, store inventories, and account receivable from store sales. Sales has increased by amount $100 million in 2 years. An increase in volume can result from an increase in the quantity of goods or services sold, or from an increase in the number of customers. This could be due to various factors such as expanding the product line, increased marketing and advertising efforts, or entering new markets. On the other hand, higher price can result from a number of factors such as an increase in demand of the product or service, in charge in input costs, or charge in market conditions. The business may also have increased price as a part of its pricing strategy to maintain or improve its profitability. To determine the specific contribution of volume and price to the growth in revenue, the business may be want to conduct a detailed analysis of its sales data over time. This could involve comparing sales volume and pricing data for different products or services, or analyze sales data for different regions or customer segments. By understanding the factors driving revenue growth, the business can adjust its pricing strategy and marketing efforts to maintain or improve profitability over time. The second question, gross margin have remained constant at 15% in each year. Are they expected to remain so, or are there pressures that will cause them to rise or fall? The answer, if the cost of goods sold were to increase significantly, the gross margin would likely decrease. Conversely, if the company were able to negotiate lower costs from supplier, and gross margin could increase. Change in customer preference or competitive pressure could also affect the gross margin. In, in general, gross margin may be influenced by several internal and external factors, and many vary depending on industry, competition, and the overall economic climate. External factors that could impact gross margin include change in customer demand, competition, change in market condition, and change in commodity prices. For example, if the cost of raw material or labor increase, this may put pressure on gross margin, unless the business is able to pass on those costs to customers through higher prices. Internal factors that could impact gross margin include change in the pricing strategy, change in the product mix, and change in operator efficiency. For example, If the business is able to negotiate better prices from supplier, it may be able to improve its gross margin. Similarly, if the business is able to streamline its operations and reduce waste, it may be able to improve profitability. Okay? In general, it's important for business and closely monitor its gross margin and identify manufacturers that may be impact them over time. By doing so, the business can take appropriate steps to adjust its pricing strategy, product mix, or operational efficiency to maintain the profitability. The third question: is the profitability of new stores better or worse than that of existing stores? Is there scope for further profitable expansion? The question, the answer, sorry. In general, the profitability of new stores may depend on a variety of factors, including the location of the stores, the level of competition in the market, and the marketing and advertising strategies used to promote the stores, and the overall financial health of the business. In some cases, new stores may be more profitable than existing stores if they are located in high growth areas or areas with less competition, or if they offer unique products or services that are in high demand. On the other hand, new stores may be less profitable if they face stiff competition or if they are located in areas with lower demand for the product or service offered. If the business has been successful in opening new stores and generating profits from those stores, that may be a scope for further profitable expansion. And however, it's important to be careful assess market demand, competition, and the potential risk before investing in the new stores or expanding into the new markets. The business should also consider whether it has the financial resource and management capacity to support further expansion. To determine the profitability of the new stores compared to existing stores, the business may want to conduct a thorough analysis of its financial statements, including revenue and expenses data for each store, and compare the results over time. And additionally, the business may want to consider conducting marketing research to assess potential demand for a new stores in different locations and to identify potential competitors and risks. The fourth question: revenue and gross profit have grown by 18% over 2 years, while salaries have increased by only 12% and the other expenses have remained constant. The result in that profit after tax has increased 67%. Is it sustainable? In particular, should be business expect there to continue to the relative low growth in operational expenses? The answer, however, the fact that profit after tax has increased by a larger percentage than revenue or expense suggests that the company has been able to improve its efficiency and or increase its pricing power. Whatever, this trend is sustainable depends on a variety of factors, such as competition, market conditions, and the company's ability to continue to improve its operations. Additionally, while it is possible that the company will be continue to experience relatively low growth in operating expenses. This cannot be determined from the financial statement alone. There are several factors that could impact the sustainability of this trend, including one, competition. Yeah, if the business operation in highly competitive market, it may be challenging to sustainable revenue and gross profit growth over the long term. The business may need to invest in marketing, research and development, and the other initiative to maintain its competitive edge, which could increase operating expenses. Two, economic conditions. If the business operation in industry that is particularly sensitive to economic conditions, a downturn in the economy could impact revenue growth and profitability. The business may need to take steps to reduce costs in order to maintain profitability, which is could impact growth in operating expenses. Three, operating operational challenges. If the business faces operational challenges such as supply chain disruptions, product delays, or regulatory changes, it may impact revenue growth and profitability. The business may be need to invest in new system or process to address this challenge, which could increase operating expenses. Fifth question: is there any reason to be concerned about liquidity? In particular, are there circumstances under which obligation to trade suppliers might not be met? The answer: additionally, the company has been able to pay dividends to share share stakeholders and increase its cash balance, and this factor suggests that the company is in a strong liquidity position. And whatever there could be circumstances under which the company might not be able to meet an obligation to trade suppliers, such as sudden downturn in sales or a significant increase in expenses. And in general, if a business is holding a significant amount of cash on its balance sheet, it suggests that it has sufficient liquidity to meet its current and short-term financial obligations, including payments to trade suppliers. That being said, if the business experiences unexpected financial challenges, such as a sudden drop in revenue or a significant increase in expenses, it may face liquidity constraints that could make it difficult to make its obligation to trade suppliers. And similarly, If the business has a large amount of debt or other financial liabilities that require regular payment, then I think it maybe face liquidity challenges if it is unable to generate sufficient cash flow to cover those obligations. And now, if you are a trade supplier to the business in question, it may be worthwhile to monitor the business financial health and keep an eye on any change to its liquidity position. And this can help you identify any potential risks to your own business and take appropriate steps to mitigate those risks. And the last question, why is the business holding so much cash? The balance sheet of the final year suggests that the bank loan could be repaid in full, thereby reducing interest expenses. The answer? Yeah, whatever. There are could be a variety of the reason why the company is holding a large of cash balance. And for example, the company may be planning to invest in new store or other growth initiative, or it may be holding a cash as a buffer against expected expenses or economic terms. There could be a several reasons why a business may be choose to hold a significant amount of cash on its balance sheet. Yeah, even it could use the fund of repay its bank loan and reduce interest expenses. The point is liquidity. Yeah, by holding a large of cash reserve, the business is able to quickly meet unexpected expenses or financial obligations that may arise. This provides a level of financial flexibility and sustainability that can help the business weather periods of economic uncertainty or volatility. Point two, investment opportunities. The business have been holding cash in active anticipation of investment opportunities that may arise in the future. Like by keeping a funds available, the business is able to take advantage of opportunities as they arise without needing to seek external financial. Point three, that debt covenant compliance. Yup, the business may be a subject of debt compliance that require it to maintain a certain level or cash reserve. If the business were to use its cash to pay off the bank loan in full, it may fall below the required level of cash reserve and risk violating its debt covenant. The last point, tax implication. Depending on the tax laws in the business jurisdiction, holding cash may be more tax efficient than using it to pay off debt. For example, if the business is able to earn a higher rate of return on its cash reserve than an interest rate on its bank loan. It may be more advantageous to keep the cash and pay the interest of bank loan. Okay, almost done, and thank you for watching this video. We will meet you again. Bye bye.